Okay, so the rest later when they come in, I will just update again. A very good morning to everyone and welcome to our additional session today. Okay, so today is a very important session because the first round that you guys did your pitching, right? Okay, so the first round that you all did your pitching, that is round one. So round two is a more detailed pitching, and investors have selected people who they want to hear more information, and that is already a signal that the investors are interested. But it's just that they want to hear more details. So the second round you will be given. Second round of pitching session, you will be given almost 2 hours, okay, about approximately 1.5 hours, plus minus. If you exceed also, no worries. Maximum is 2 hours per person. So in this 1.5 hours session, okay, which 1 hour will be your presentation and half an hour of Q&A. Maybe the Q&A might extend to 1 hour as well, okay? So that's why we kept it at maximum 2 hours. Now in this next session, you're going to have more details that is going to be given. And the investor has given us a guideline, a sort of due diligence that you need to prepare before your second pitching, because your second pitching is a very important pitching. It is a make or break deal. All right. So that is why we have to prepare you for round two. And I'm going to be conducting this session today, the whole, for this entire 2 to 3 hours. Okay. And I'm going to, for 3 hours, right up to 1 p.m. And I'm going to go through with you what are the things that you need to cover for your second pitching session. So it is a very crucial, very important session, because if you are not well equipped with the information that is required by the investors, then you are going to, not attract them any further, because there is the next round is they are going to already decide decision making. So this is a very important stage, because this is a decision making stage for the investors. So that is why you need to be well prepared in order for you to pitch to them. Okay. So, all right. Hi, welcome everyone else who just joined in. Shamim. Hi, morning, Shamim. Hi, Shamim. Good morning. Can you hear me? Hi, Shamim. Mim, hi. You're muted. Can you please unmute and let me know if you can hear me?
Yeah, hi, morning.
Hey, hi, morning. Shamim, how are you?
Yeah, I'm good.
Okay, Shamim, I received your documents that you couriered to me. Thank you so much for that.
Okay.
And I noticed that you have not put your latest 3 months, the 3-month section is not completed. So can you just text me? Can you just WhatsApp me? What is your latest 3 months?
Okay.
That means because you put here March, we don't want the total sales. Jumlah jualan untuk bulan Mac sahaja kamu letak dekat sini. Tapi yang kita minta ni 3 bulan terakhir ataupun 3 bulan terkini. Iaitu September, Oktober, November.
Alright. I will update you soon.
Tolong update. Just WhatsApp I pun boleh lah. September berapa jumlah jualan syarikat kamu. Lepas tu Oktober berapa and then November berapa. Alright?
Okay, so.
Alright, thank you so much. Yang lain semua okay lah. Yang lain semua complete. Itu je lah. Okay, thank you. All right, I believe Kalai joined us, right? Kalai, good morning to you, Kalai. Kalai, morning. GFMB marketing. Can you hear me? Morning, Kalai.
Hello.
Hi, good morning, Kalai.
Hey, good morning. Okay.
Okay, same thing. I received your documents. Thank you so much for that. Your page 2 is also not complete in the jualan 3 bulan terakhir, which is ataupun 3 bulan terkini, which is your latest 3 months, September, October, November. What was your sales for these past 3 months? Just your total sales amount. Okay, not profits,
Okay.
sales, total sales. Okay, so can you just WhatsApp me? October, how much? Sorry, September, how much sales? October, how much sales? November, how much sales? Just WhatsApp me.
Okay, can, sure, no problem.
All right, thank you. The rest is all okay, complete. Just this part
Okay.
alone, this section alone.
Okay, there's only 2 pages, if I'm not mistaken, and it will be until November.
Until November. So September, October,
Yeah,
November.
yeah. So is it September there? September, October, November?
You left it blank. This part here, okay, let me just show it to you.
Sure.
Jumlah jualan. Can you see?
Oh, okay, okay.
So the latest 3 months is not there. Actually, we started this program in November. So technically, we just need your August, September, October.
Okay,
Shamim
awesome.
also. Shamim, just send me your August, September, October.
Just text the figure, huh?
Just text the figure. October how much? August how much? September how much? October how much?
Noted, noted, noted.
All right. Thank you. Thank you so much. Thank you, Kalai.
Yep.
And Diba is not in, right? Yeah, Diba is not in. No worries. Be coming in late a bit. Hi, morning, Eza. Welcome.
Morning, Al.
I hope you're on hands-free since you're driving. You on hands-free?
Yeah, I'm parked my car by the Petronas right now, actually.
Okay, when you're
5 minutes
driving,
break.
don't look in the camera because then the pantulan cahaya dari kepala air itu akan mengganggu kamu punya penglihatan nanti tak boleh nampak jalan.
Thank you, no worries.
So pakai cermin mata hitam lah, wear sunglasses if you don't want to see the reflection. It's brighter than the sun right now. All right, welcome everyone. A very good morning to everyone, and thank you all for joining our session for today. Welcome, and just to brief you, what is the session about today? So I have some good news for some of you here. Okay, we are going to share the good news with you shortly. But before that, I will have to prepare you for this session. So what is this session about? Basically, today's session is an additional training session that I've organized for you guys. We have already completed all our sessions, our 40 hours. Am I right? We have completed our 40 hours training and our 12 hours of coaching. So that's 52 hours of knowledge has been downloaded into your mind. How does that feel? You know, from where you started before right up to now, have you gained a lot of experience and knowledge?
Phil Einstein.
Sorry?
Phil Einstein.
Huh? Sorry?
Phil Einstein.
Oh, you feel like Einstein. All right. So, you know, we want to continue this journey because we just don't want to complete our requirements and then just wash our hands off. We don't want that. We want to stick with you guys until you guys have achieved your objective of growing to the next level financially. Okay. For your company to excel and also to acquire the fundings that is required and to grow financially. So that is why we are going to hand guide you guys throughout a period of time. And even after this program is over, also please do not exit this group. Continue to be this group so that we can keep you all updated on a lot of things, and and this group will, we will empower each other through this WhatsApp group. Okay, for the next couple of months at least, to see how, and also for me to follow up with all of you all on your status, and for each of you guys to support each other as well. Because remember, what is Business Warrior all about? We leave no soldiers behind. We leave no warriors behind. So everyone must succeed and everyone must grow together. All right. So that is our philosophy, and that is what I encourage everyone to do. To always support each other and grow together, because that's the way our warriors do it. All right. Am I right or not? Okay. So all right. So let's get started with our session. Okay. So thank you all so much once again for joining this session on a Sunday morning, on a long weekend. Some of you, I believe, are traveling. Be safe, okay, while you're hearing just don't have to look at the video. Just make sure your hands and you're using your hands free. Okay. And also for those of you who are enjoying your holiday somewhere in some beautiful island, I'm sorry for taking your time off and you have to see this face on a holiday. I'm really sorry, but I have to do what I have to do, right? Okay, so the objective of this program today that I've organized for you, this additional training session that I've organized for you, this 3-hour session, which is going to take place from now right up to 1:30 in the afternoon. I'm going to guide you on certain important things that you need to have or to prepare before you meet your investors the second time. Okay, so some of you have been selected to go for the proceed for the next round. But I want to give the knowledge to everyone. Even if those who are not selected also, you can still continue to learn because you know why? This round maybe not, but next round you will never know. We might have another session next year. I'm already started to work on other projects that is similar to this. And I will be keeping all of you all posted. That is why I encourage everyone to continue to be in this group because there's going to be more programs like this coming up. And I want all of you all to be updated on the programs. Okay, so that is why I encourage all of you all to continue to be in this group. So today's training is all about how to prepare yourselves when you meet the investors for the second round. Okay, and the second round is going to be a more detailed session. You're going to have approximately almost 2 hours. Okay, about 1.5 hours to 2 hours session. And in this 2-hour session, you're going to present a very detailed presentation, and there's going to be a lots of question and answer session. Okay, the Q&A session is also going to be very long. The investors are going to ask a lot of questions. So just imagine your session is about 1.5 hours, almost 2 hours. It may drag up to 2 hours. So this time you just have to give all the details and all the information to convince that investor that choosing your company to invest is the right decision for them. So in order for that to happen, we have to really prepare ourselves, correct or not, for the presentation. Because if you're not prepared, and if you go in like a half-baked job, then the investors might not have the confidence. So if you don't have the investors' confidence, you might not get invested in the investment. So that is why I rushed to have. I just only finished the meeting with Ian, and he has told me what he requires, and I put all of this into a program, and I took about 2 days, just 2 days only, 2 to 3 days only to prepare this whole program. Even my Christmas also, I was busy doing work on the laptop, and my wife was making so much noise. Hey, Christmas, you're not, spending time with the family and the kids, and you're on the laptop. So this is how much I'm dedicated to ensure that you guys succeed in this business, in your objectives and achieve your objectives. All right. So what we're going to prepare you is, number one, we're going to teach you how to calculate the value of your company, how to establish a value for your company, because that based on that value, the investment amount will be given. So if you're asking for 1 million ringgit, example, and if you're giving 10% equity to an investor, it means your company is valued at 100 million. So the investors are going to ask you, are you sure that your company is 100 million? Can you prove to me that your company is 100 million? And then if you can't answer them, you lost it. So this is very, very important for you to know how to ask what type of shares are there involved, the various types of equities, shares, okay, preference shares and all kinds of shares, what kind of shares suits your business or what kind of share meets your needs. All these we're going to dive in, okay? And then we're also going to learn this thing called ARPU, ARPU, average revenue per unit or per person or per client or per customer. So how much revenue does one client generate? So we're going to learn that as well. Okay, we're going to learn how much cost does it incur for you to acquire a customer acquisition. See, all these things are very important, right? Because with all these information, we will be able to pitch effectively to the investors. All right. And then also, I'm going to be teaching you another thing called ARPU, and yeah, I'm also going to be teaching you how to determine what kind of exit plan or exit agreement that you need to have when you go into a relationship with your investors. When the investors come in, okay, how are you going to how do I say it? How are you going to exit, or what is your exit strategy? So that's very, very important as well. Okay. So these are the things that is going to be covered in today's session. So without wasting any more time, let's straight get started with our session. Okay. All right. I'm going to share my screen right now. Okay, but before we get started, I'm going to break you all up into groups. Okay, I'm going to break you all up into two groups. Okay, there is 15 of you, 3 groups. Each group will have 5 of you all. Okay, and I want you all to discuss what are the types of shares are there in the market. I mean, what kind of shares are available. Okay, so and what is the definition of each of these shares? So what are the types of shares and what is the definition of each of these shares? So I'm going to give you about 5 minutes to prepare, to just research, discuss among yourselves, and then I want the representative of each group to give me your answers. All right. So can I just split you all out into breakup rooms? Okay, good. I'm going to put you all out into breakup groups. Okay, there's actually 14 of you all. 15 is including me. So there's 14 of you guys. And we're going to have 2 rooms. Okay, we're going to have 2 rooms. So each room will have 7 participants. Okay, and I'm opening the room right now.
Testing 1, 2, 3. Can anyone hear me?
All right. Welcome back. Welcome back, everyone.
Yep.
Okay, so let me know, what have you found? What kind of shares are there available? Anyone, please unmute and speak.
Brian here, good one.
Okay, Brian.
Preferential share and ordinary share.
Okay.
Preferential share is no voting right. Ordinary share got voting right.
Okay.
If there's a debt, of course, preferential share will be the first one to get the money, followed by ordinary share.
All right.
You can, of course, preferential share will get some interest if they opted to accept the preferential share. But there are also some redeemable and convertible preference share upon maturity, whereby upon maturity, the preference share will be redeemed by the share owner, or they can use it to purchase the ordinary share in the company. So the purpose why the business owner want to offer preferential share is they want to raise further rounds, and business owner just want the money to get started. Of course, business also want to get the right partner in, not only just put in money, but to contribute in terms of knowledge, skill, networking. Then only will be accepted as a partner and gain access into the ordinary share. That's my sharing. Thank you.
All right. Very good. Very good. Very good, Brian. Thank you. Anyone else want to add on? Anyone? Anyone? What about the other group? What about the other group? There's two groups. So Brian's group and the other group. Hello, why is this group so silent? Were you guys discussing, or you guys took a break during the discussion? Hello?
Brian already mentioned everything.
Sorry? Yes, Paris?
yeah, we did discuss with Izaida and as well as Ruben Sai.
Okay.
So Ruben mentioned that there's three types of shares, which is convertible preference shares, redeemable preference shares, as well as irredeemable preference shares. I think to go about all of it, I think we have to invite Ruben Sai because he's the one yang tahu lebih.
Okay, Ruben, maybe you'd like to share, Ruben?
Yeah, actually, 1 second. Okay, convertible preference shares. So one is it can be converted into equity share within a certain period. So that's the definition for the convertible preference shares.
Okay.
For the second is redeemable preference shares. That one is shares which a company may repay after a fixed period of time or earlier. So
Okay.
this one, they have a time period for the sharings. Okay,
Okay.
the third is irredeemable preference shares. So this one, shares are repayable only at winding up. It does not carry the arrangement for redemptions. So that's all from my side. Thank you, Albert.
All right, very good, very good. Anyone else want to add? Anyone else?
Albert, can I add another one more?
Sure, sure.
Okay, there are another one more shares.
Yes, what is it?
Non-participating preference shares.
Sorry?
Non-participating preference shares.
Okay, what is that?
So that one does not share the surplus profit, fixed rate of dividend of guaranteed.
Okay.
So that's all.
Okay, very good, very good. All right, thank you, Ruben. Thank you so much for your sharing. Thank you very much. Anyone else want to share? Anything that has been missed out? Okay. Anything else before I begin? Okay, so if there is no one else who would like to share, then let's begin our session today, where I'm going to be sharing with you what are the various types of shares, what are the difference, and what is the criteria of each of these shares, advantage, pros and cons, all that. All right. So let me share the screen now.
Melbourne, you will share the slide later.
Yes, I'll be sharing the slide later with everyone. This is
Okay.
very important for you to know what we're going to be covering today. Okay, so welcome to the next step session. Okay, so the next step is basically to launch you to the next step of the investor pitching session. Okay, so we had successfully conducted our pitching session on the 16th of December, and also for those who couldn't make it on the 16th, we gave them another session on the 24th of December. There were 3 participants who pitched on the 24th. So today we are going to reveal who are the participants who have successfully made it to the next round, where the investors want to know more in details. All right. And for those who did not make it, don't worry. Do not feel disheartened, because we will have some arrangements that we will try to work out to see how we at Business Warrior can help the participants, so that you will be not left out at the race, and we will see what other support that we can contribute in order for you to equally benefit with the rest, so that every single participant benefits from our session. All right. Okay. All right. One small step for man, one giant leap for mankind. This is indeed a small step that we all have taken, but it's going to be a giant leap for those who are able to not just successfully get funded, but to proceed to the next level. Okay. All right. Firstly, I would like to congratulate each and every one of you who have participated in the pitching session. So thank you all so much for contributing to the pitching session by giving your pitch, your presentation, which has been a phenomenal success. All right. Everyone, every participant who pitched did very well. So congratulations to all of you all. All right. Now, the next round of our pitching session, okay, you are going to have approximately 45 minutes to an hour to present and another 45 minutes for Q&A session. Slot may extend up to 2 hours, okay? So this is a very detailed pitching session that is going to take place. And round 2's pitching session will begin somewhere around middle of January. So I have given you the reason why I had to rush and do this training today and not delay it is because I want to give you ample of time to prepare your pitch deck for the round 2, okay? So the round 2 will involve more work, more what do you call this, analytics data, and more research and more input, okay, because it's going to be a very detailed one. And remember, your time is about almost 2 hours, 1 hour of pitching, you know, so you have to prepare a very, very detailed presentation. So that is why I'm giving you approximately 3 weeks, 2 to 3 weeks to prepare yourselves and to prepare your pitch deck for the next round, okay? Especially your finance part, because that's what they want to see. All right. So there are certain requirements that you need to fulfill. All right. And you need to prepare before your pitching session. Number one, you have to prepare your revenue forecasts for your business for the next probably 6 months to a year, or maybe 2 years or 3 years. What is your forecast? We're going to teach you how to do a forecast. Okay. Next, you will have to give us your audited report for your company. Because your audited report, or rather your management accounts, for those who are not the Sendirian Berhad, then we need your management accounts. Just mute everyone. Okay. So your management accounts and your audited report is where the investors will study and see how healthy has your company been financially. Okay. And also they will evaluate your company's financial performance, track record, your past, your previous, your historical track record, in order for them to be able to justify and to be able to assess and see whether is it a good idea to invest in you or not. Okay, because you have to study a person's history of business in order for them to be able to determine whether they want to invest in your company. So this audited report and also your management account is very important. So for those who are not having a enterprise, who have an enterprise, who don't have a Sendirian Berhad, okay, your report would be a management account. So management accounts involves your profit and loss as well as your balance sheet, okay. So these two are very important documents, your balance sheet and your profit and loss, because then we will be able to determine not just your profit, your revenue, your net revenue, but we will also be able to determine what's your profit margin. Okay, because the investors want to know what is your profit margin. So the next one, point number three, what's your profit margin? See, remember one thing, the higher the margins are, the more appealing it will be to the investors. Why I say this is because imagine if you have a product that you're selling, okay, and the cost to make your product is probably 1 ringgit, but you're able to sell that product for 10 ringgit, and you have a good track record to show that yes, there is demand for your product, even though it's selling at 10 ringgit. So your profit margin is very, very high. Correct or not? 1 ringgit you're producing it, cost, and you're selling it at 10 ringgit. So your profit margin is really high. So that's good. Some people may produce an item for 7 ringgit. Okay, their cost to produce something is 7 ringgit, and they sell it for 10 ringgit. So their profit margin is smaller. So their profit margin is only about 30%. Okay, so this is, it is, I'm not saying it's not appealing to the investors, but what I'm saying is that always try to make sure that your profit margin is not very low. Okay, it has a high profit margin of at least 30% and above. So imagine if you're producing something for 8 ringgit and you're selling it for 10 ringgit, 20% margin. That is definitely, or 10 ringgit you're selling and you're producing the item for 9 ringgit. So that is definitely not a very good profit margin, and it's not good business model. So your investors may not invest or even consider investing in you. So that is why what attracts an investor is, one of the key things that attracts an investor is their profit margin. They want to see what's your profit margin. How good is your profit margin? Next, the investors would also want to identify what you want to offer them. Okay, so what kind of shares? Like what I told you earlier, to survey and research, there are various types of shares. Okay, the equity shares, also known as the ordinary shares. Okay, and then you have your preference shares, redeemable preference shares. So all these I'm going to be sharing with you what are the differences between all these shares. Okay, so that you will know what kind of shares to offer your investors. Next, what is your buyback, or rather what is your exit agreement or exit strategy? So they want to know what is your buyback. Example, if you have sold your shares to them, and you've locked in a period of 5 years, example. Okay, but in less than 5 years you want to buy back your shares from them. So what kind of agreement is there? Because at 5 years down the road, your company value may increase, business may increase, so the share value may increase. So how do you buy back? So what is your buyback agreement and what is your exit agreement with them? They want to know that as well. And last but not least, what is the investors' ROI? They want to know how much is their return on investment over a period of 1 year or 2 years, 6 months. If they put in the money, when can they see their returns? How fast can they see their returns? They want to know. Okay, and what's in it for them, basically. Okay, next, let's look at how to create a revenue forecast. Okay, so how do you forecast your revenue? So there are a few ways of how you can predict or forecast your revenue. So revenue forecast is to predict as accurately as possible the future of your company's revenue. And revenue forecasts are usually based on few things, which is number one, quantitative forecasting. Okay, what is quantitative forecasting? Based on your data, your current data or your numbers. Okay, what is your numbers? What is your current sales that you have right now? What is your profit margin? See, all that they will know already, right? So once they've once you have given your info, okay, your audited reports, they will identify what's your profit margin like. So once they know what's your profit margin, and here you have forecasted your revenue, your gross revenue, or rather your sales for this next 1 year, this is our forecast based on our current data that we have. Current year, this year and last year, we did this much. So we are forecasting that next year will be this much. So when you give them that info, they will already know how much is their margin, what is the profit margin. And when they do that, they will know how much money to put in and how fast can they collect their money back, and is it profitable or not. Okay. So you'll have to consider your historical records, your current pipeline. Okay, for those of you who are not in a product-based business, example, you're in a service or project-based business, and currently your pipeline has X amount of projects lined up. Okay, confirmed pipelines are confirmed projects. So based on that, they will consider that, okay, this is also a way to project your revenue, to forecast your revenue based on your current pipeline. And also, of course, your expenses. What are your expenses? Your monthly expenses. And also they will, to forecast, you may want to consider the market condition also, all right? These are all the various ways of making a forecast. Now, another thing is called the sales forecasting. Okay, so sales forecasting is where you can forecast the future sales based on what are your new strategies. Example, currently, okay, you're doing this X amount of sales, but you're telling the investors that, but for next year, we are changing our strategies. We are implementing new strategies to increase our sales, such as we're increasing the marketing budgets so that we can increase our marketing campaigns, or we are increasing our sales distribution channel. Currently we only have 2 distribution channels, but now next year we're going to have 5 distribution channels. Or maybe you want to tell them that, we are also increasing our manpower, our sales manpower. Maybe now we have a team of 3 salespeople. Next year we are hiring 6 salespeople. So we are expected to do more than what we have done for this year. Okay. Or if you have a strategic partnership or new venture, then you may want to highlight that as well and put that into your forecast. For instance, example like, I like to give an example like what Al Arifi has mentioned. They have a new venture whereby they're currently operating a Arabic food restaurant, and also they have a swimming academy. And now their current new venture is they have an offer to take over a clubhouse, an entire clubhouse, and run the clubhouse, and also to purchase the entire property on a leasehold. So this is something that they can put and they can forecast and say, our sales, because the clubhouse has, we have various revenues from the clubhouse. We have a swimming academy from there. We have restaurants that we're going to rent out. We have a saloon that we can rent out, also shop lots that can rent out saloons, So all these are revenues, and this is our forecast for each of these revenues, a rough estimation. Okay. So these are things that you can forecast. Or even, for example, potong gula, all right, Anas. For instance, if you want to forecast your next year's sales revenue, you can tell the investors that, okay, next year we are increasing our distribution channel. Okay, right now we have this many suppliers, distributors. Next year we are increasing the numbers to probably double or triple. So you can expect to see an increase in sales. So these are the things that they want to hear. So these are the ways. So when you forecast, it has to be something substantial, and it has to be something that is relevant. Okay. So please make sure that your forecast is backed or based on facts and figures, not just something that is plucking from thin air. So investors want to see something that is really backed by data, backed by facts, backed by figures, backed by proof. So make sure that your sales, or rather your quantitative forecasting, has proof. Okay, so all clear so far? Is everyone clear? Any questions so far?
Clear. Is it this second round is going to be face-to-face or Zoom?
It's still going to be Zoom. It's going to be Zoom, but it's going to be, each participant will have 2 hours session, and we will only allow 1 week, 2 participants only can make a pitch, because of the time frame that is given by our investors. He won't be able to have all the participants in one day, because imagine if there's 2 hours, 10 of you already, there's 20 hours. So we're going to break it into such a way that every week 2 participants will go. All right, is that good? Any other questions?
Is it same batch of investor?
Yes. The investor is the same investor, because he has shortlisted who will be going for the next round. So all those who have been selected will be pitching to him for the next round. So any questions on revenue forecast so far? So everyone clear how to forecast your revenue? Okay. Now, I have a video that I'd like to share with you, and this video basically will also share with you on financial projection.
Developing the financial projections for your startup may seem a daunting task. After all, How can you know what type of revenue and costs your business will encounter in its first year of operation, let alone the first 5 years? Putting the projections in the plan and presenting it to funders also seems so final, as if saying you promise stand by these numbers. How can this be the case when you feel extremely uncertain about the projections? In this video, we are going to share 6 major components of financial projections for startup. 1. Financial goals and objectives. Every startup owner wants to make as money as possible from those startup. But how much money do you really need? What are the financial goals you want to achieve with your business? You need to write all of your financial goals and objectives in your financial projection. 2. Income tax planning. Ignoring tax planning is very common among many small business owners. It is not an optional process, so be sure you are on the correct path when dealing with your taxes with the help of a professional, who will help you through the ongoing process that helps small business review their total income and manage the expenses every month. 3. Balance sheet. The balance sheet boldly declares where a business stands at a given moment in time. From the balance sheet, a financially sophisticated reader can learn an immense amount of valuable information about a business and its viability. That is why potential investors and lenders will almost always ask you for a copy of your financial statements, including the balance sheet, income statement, statement of retained earnings, and statement of cash flows. 4. Risk management and insurance. No matter the size or nature of your business, one thing that remains the same is the need for business insurance. There are many different aspects of your business that you want to take into consideration when looking for new business insurance or reviewing your current insurance coverage. 5. Cash flow statement. In financial projections, a cash flow statement or statement of cash flows is a financial statement that shows a company's incoming and outgoing cash during a time period. All 3 statements are arranged from the same accounting information, but each statement serves its individual function. The statement of cash flow reports the movement of cash into and out of your business in a given year. And 6. Investment planning. Investments are all about working out a particular financial projection so that you can get from one place to the other. It is precisely due to this investments are known as investment vehicles. Investment planning is a must if you want to reduce the risks associated with losing money that you earned from your business. Only a solid plan and financial projection will ensure financial success in the future. If you found this video helpful, then like, share, and subscribe our channel to get future videos.
Right. So basically, this video explains how do you create your financial projection. Okay, as you can see, financial goals need to be set at the beginning of the year in order for you to, your very first thing is to set your objectives for this year, your goal settings. All right. So when you start doing your goal settings, then you may want to put down your strategies, and your strategies is where you're going to derive your projection or your income projection for next year. All right. So now also another thing that I would like to share with you is get in touch with your accountants. Okay, I'm sure all of you have your accountants who does your accounts for your company. Get in touch with them and speak to them and ask them to help you to create a financial projection as well as a revenue forecast, so that you can prepare a very concrete forecast and present it to the investors backed by data. All right. So far, any questions on your revenue forecast and your financial projection? Okay, if there's no questions, then I would like to give approximately 15 to 20 minutes for each, but well, let's not take 20 minutes. Let's take about 10 minutes, okay, for each participant to prepare a projected revenue. Just a basic, if you can prepare it in 10 minutes, then it's good. But if you can't and you don't have the data right now with you, then it's okay. But for those of you who have, can you just prepare a very brief projected revenue based on your data that you have currently with you and your current pipeline? And then we would like to invite probably a few of you to present the forecast. Okay, so can you take about 10 minutes, not 20 minutes, 10 minutes to do this? Okay. Have you all done? Anyone who has completed? Alright, who has done their revenue forecast? Can you share? So we have given access to anyone who wants to share. So anyone? Anyone done your revenue forecast? Hello? Hello? Guys?
Hi, Mr. Alban.
Yes, Anas.
Yeah.
Would you like
Okay.
to go?
Okay.
Go ahead, proceed, Mr. Anas.
Okay. So can I just please, tell you the revenue projection?
Sure, sure.
Okay. So as of next year, we're expecting to make around 2.5 million based on our new distributor. and
You're
their
for
pipeline.
2021, right?
Yes, correct. Yeah.
Okay.
There's how numbers, but of course we will increase more, but there was like the targeted one that we are actually already securing, and it will be through the pipeline of small outlets, and also B2B, because we are planning to head to the Mama Ali Maju restaurant, and also their chain of other Mama outlets, basically. Yeah. So targeted with 2.5 million ringgit.
Okay. So these are all based on your pipelines and also your present data, right?
Correct. And also the capability of the distributors.
Capability of distributors. Okay. Very good. Very good. Thank you. Thank you so much, Anas. Anyone else would like to share? Anyone? How about EJ? Have you done your revenue forecast, EJ? EJ? EJ, is it?
Can I share with you later, Alvin? I'm a
Okay.
bit tied up with something.
Okay, sure, sure, sure. All right. Okay, good. So anyone else want to share their revenue forecast? Projected revenue or projected financial projection? How about Mr. Vicky? Mr. Vignesh Maran? Okay, hello guys, are you all there?
We hear, tapi would love to hear from others first lah, because nak tengok daripada orang pengalaman dulu.
Okay. Hey, anyone? No worries. You can share also. That's because we're here to learn. I want to make sure that all of you get this right. So don't be afraid. Raffo or Nicholas, how about you, Nicholas?
We're estimating about 1.8 million in the next year.
Okay, so how did you get that estimation?
We will have another 5 kitchens and we'll be launching an online grocer as well.
Okay, so currently each kitchen, how much is it generating? You have one kitchen right now, right?
Yeah, we're generating about 30 to 50,000 per month.
Sorry, how much?
30 to 50,000 a month.
Okay,
Yeah.
30 to 50,000 a month. So approximately, I think it average as 40,000 a month. So that's about 480,000 a year.
Yeah.
So that's 480. So let's just take an average of 500,000. So you are opening up another 5 kitchens, right?
Yep.
So your projected revenue is
1.8.
1.8.
Yeah.
Technically, you can do actually more than that based on your current run rate, but
Yeah.
But I'm guessing you're not being very ambitious, over ambitious, like you're being cautious with your
We'll
number.
be more realistic in that sense.
More realistic.
Yeah.
Very good. Very good. Very good. So Nicholas, I'm sure you have your facts and data that you would like to present to them, right? When you talk to them about the numbers.
Oh yeah, definitely. Yeah, because I mean, I have my financial statement, financial model, and everything already. It's just that, yeah, I'm just finalizing it because we are adding on new things as well.
Very good, Nicholas. Very good. Very good. Okay, so anyone else? Or is it too PNC? If you don't want to share it, then no worries if it's PNC. I just wanted to see whether you all are on the same page as I am so that you guys know how to do this. All right. Okay. So if no one else want to share? Okay. So then let's move on to our next session. I'm going to just share the screen. Does anyone want to have a break, a 5 minutes break? Anyone? 5 minutes break? Or should we just proceed?
I think we just proceed. Yeah, it's cool.
All right, cool. I'm going to share my screen once again. Can you see my screen? Everyone can see my screen, right?
Yeah, we can see your screen, Alvin.
Okay, cool. So now let's dive into the topic of the shares that we were discussing earlier of this program. What are the types of shares? So yes, as some of you, Brian and Ruben, have mentioned, there are the ordinary shares, also known as the equity shares. Okay. So what is the ordinary share? Basically, that's the most common type of share, okay, where you have your rights to vote. What is voting rights? That means you can vote who will be the managing director or the CEO of the company. Okay, so this is called a voting right. You have the rights to vote who should stay, who should leave. I mean, who should be appointed. Okay, and also you have the potential to get the highest financial gains. Why? Because the ordinary shares are not like your preference shares, which I'm going to share with you in a bit. Okay, these ordinary shares or equity shares are based on dividends of the company. Okay, so they have the potential to give the highest financial gains, but also have the highest risk. Okay, why I say you have the highest risk is because you, in a case of a company going, this is risk for who? Investors. Okay, because if an investor invests and if the company goes bankrupt, and when they dilute those or rather liquidate the assets, the people who will be getting their shares are the people who are the preference shareholders. They will be the first priority to get their shares. Okay, so however, I'm going to also tell you what are the pros and cons of preference shares in a while, but first let's talk about ordinary shares. So ordinary shares, basically you will get dividends based on whatever shares. Example, if your shares, you're paying, the investors are paying about X amount of money for 20% of your company or 25% of your company shares, then they will be getting every year 25% of the shares from the company. Okay, from the revenue of the company. All right. So if they invested and bought 30% of your company, then they will be getting 30% shares from your revenue of your company. Okay. Now there's also the non-voting ordinary shares. The non-voting ordinary shares, it carries the same condition as the ordinary shares, except that you do not have the voting rights. Okay. Shareholders may have voting rights under certain circumstances, or they may have no voting rights at all. So these are ordinary shares. Basically, it's a straightforward type of common share whereby you pay X amount, the investor pays X amount, and they get their shares for that amount that has been declared to them. Now there is the redeemable shares. So what are the redeemable shares? Redeemable shares are issued on terms that the company will or may pay them back at a future date. Okay, that means I acquire certain shares from your company, but after a certain period of time, you can redeem your shares back. You can buy back those shares from me. This is either fixed or set at the director's discretion. Okay, it's usually done with non-voting shares given to employees, so that if the employee leaves, the shares can be taken back at their nominal value, right? And then comes the next type of share, which is the preference shares. Okay, so what are preference shares? Preference shares are more commonly referred to as preferred stocks. Okay, and the shares of a company with dividends that are paid to stakeholders before common stock dividends are issued. Okay, so that means they are the preference, they are the priority shareholders. Like in other words, preference shares are also the priority. So before the common shareholders get their dividends, the priority or the preference shareholders get their dividends first. Okay, it will be issued to them first. And of course, if the company enters into bankruptcy, the preferred or preference shareholders are entitled to be paid from the company's assets before the common stakeholders. So if before the common shareholders can get their payment, the preference shares will get their payment from the company's assets if the company goes into bankruptcy, right? And also remember that most preference shares have fixed dividends. Okay, that means what? It means I give you a certain amount and you just give me a fixed amount of dividend. Okay, it's like something like a loan. Okay, so in other words, these shareholders are actually giving you a loan and they said, okay, fine. Every year, this is how much I will collect, a fixed dividend. Whether your company is making profit or not, I don't care. I must get that percentage of dividend. The ordinary shares, no, they go with the company's ups and downs. Okay, if the company is doing very well financially, then they get a higher return. Company is not doing so financially well, and they get a lower return. But a preference share person is different. They have a very fixed amount, okay, of dividend that must be paid out to them throughout a period of time that has been agreed. During the agreement time, they'll say, okay, I'm investing for 5 years or for 3 years or whatever it is, and every year I must get this much until I get back my capital, whatever that I paid. It's exactly like a loan. Okay, so preferred stocks shareholders, or rather preference shareholders, also typically do not hold any voting rights. Okay, so they cannot vote, but the common shareholders can. All right. Now, these are the features of a preferred shareholder. Okay, so preference in assets upon liquidation. Okay, as I mentioned, the moment a company is into bankruptcy or if they are liquidating the assets, they will get a preference to get the shares from the assets. Okay, and then dividend payments. The shares provide dividend payments to shareholders, and the payments can be a fixed or floating. Okay, based on the interest rate benchmark, such as the this is an American term, all right, LIBOR. Then next comes the preference in dividends. Okay, preferred shareholders also, or preference shareholders, have the priority in dividend payments over the holders of the common stock. So when it comes to dividend payouts, they will be the first to get. They are the priority ones. Of course, they cannot vote, non-voting rights. And then there is the convertibility to common stock. So these preferred shares may be converted to a predetermined number of common shares if they want to in the near future. Okay, some preferred shares specify the date at which the shares can be converted. So some of the preference shares will say, okay, after X period of time, I want the shares to be converted into common shares. Also can be done. While others require approval from the board of directors for the conversion. All right. So these are the types of preference shares. So in the preference shares also, there are various types of preference shares. Okay. So we have the convertible and non-convertible preference shares. So what are the convertible shares? They possess an option or rights to whereby they can convert into an ordinary shareholder at an agreed terms and condition. Non-convertible are those who are preference shares that cannot be converted. They do not have this option to convert those shares to ordinary shares. And then there is the redeemable and irredeemable preference shares. So what is a redeemable preference shares? Okay, it has a maturity date on which the date of the company will repay the capital amount to the preference shareholders and discontinue the dividend payment. All right. Irredeemable does not have any maturity date and the dividends of these shares are fixed. Okay. Next comes the participating and non-participating preference shares. So what is it? So the participating preference shares has an additional benefit of participating in profits of the company. Like I mentioned earlier, remember preference shares? Irrelevant of your company's profits, they will get a fixed amount, right? But if it's a participating preference shareholder, then yes, they have an additional benefit of participating in the profits of the company apart from the fixed dividend. That means on top of the fixed dividend, they also can acquire the profits from the company. And then other preference shares who do not participate are called non-participating preference shares. And then we have the cumulative and non-cumulative. So what are cumulative? Dividends are accumulated and therefore paid before anything paid to the equity shareholders. Non-cumulative are if company does not pay the dividend in current year, claim or preference shareholder is lost to the extent. So what does that mean? So cumulative are those who are accumulate and they will be paid before the normal or common shareholders. All right. And then last but not least is the shares with callable option. So what is a callable option? So companies has a right to redeem the preference shares in between. So if they want to redeem the preference shares, they can. Such preference shares will be redeemed at a premium if they're redeemed in between. So if before the period of time if they want to redeem, the company wants to redeem the shares, they can do it at a premium rate. Okay. And then the company will also exercise such options if rate of preference dividends is falling in the market. So why would the company want to do that? Is because the rates of the preference dividends is falling in the market. But this is mostly applicable for the Berhad companies, okay, or rather the listed companies. Okay, now I would like you all to discuss. Okay, I'm going to create 3 groups right now, and I want you to discuss the pros and cons of each shares: the ordinary shares, preference shares, and the redeemable shares. Okay, so I'm going to break you all up into 3 groups. There is 12 of you all, so each group will have 4 participants, and I want you to discuss the pros and cons. All right. Pros and cons of, remember, each of these 3. Yeah, each one: preference shares, common shares, and redeemable shares. Sorry, I accidentally created 2 rooms instead of 3 rooms. I need to. Let me add 1 more room. Okay. I will assign you to room 3. All right, welcome back, everyone. So I believe that you have discussed in your groups the pros and cons for each of these shares. So I would like to hear from the representative of each group. So can we have group 1? Group 1, you have discussed ordinary shares. So what are the pros and cons of ordinary share? Can anyone share? Hello, group 1. Anyone there? Group 1? Hello?
Who's group 1? Huh?
Okay, guys who assigned, is that group 1? Okay, who discussed ordinary shares? Which group discussed ordinary shares? Which group? Any group? Hello? How about preference shares? Which anyone want to share about the preference shares? Pros and cons? Which group discussed about preference shares?
I again invite Ruben lah. Ruben, he knows a lot.
Okay, Ruben, could you share with us?
Okay, Alvin. Okay. For the preferred shares, so the advantages, there are
Okay.
no legal obligation for dividend payment. The first.
Okay.
So the second is no dilution in control.
Okay.
So the third is no charges on assets. So these are the advantages, and the disadvantages is costly source of finance. Second is keeping dividend disregard market image, and the third is preference in any claims.
These are for your
Preference.
preference shares. Okay, good. Did you also survey on ordinary shares?
No.
Okay, good. So your group did preference shares, huh? Anyone did ordinary shares? Okay, but anyways, thank you so much, Ruben. Thank you for your sharing. So as what Ruben mentioned, yes, very good. I would like to add on certain points to that, Ruben. Okay. So I am going to share in the group right now, okay, in the what do you call this, in the chat group. Okay, I'm going to share a attachment in the chat group so that everyone can have a look at this. Okay. I hope you all have received it in the group. See the comparison. Okay, so this attachment is for your reference. I am going to share it also on the screen right now. Can you all see my screen? So I've shared this with all of you all, right? So this is a comparison between the shares of ordinary shares and preference shares. And as what Ruben mentioned, and in more details here, so the common shares are the types of, the most common shares are the ordinary shares, okay? And by definition, the preference shares is a share or by whatever name called, which does not entitle holders to have the right to vote or participate beyond specific amount of distribution of dividend. Okay. So you see, users hold as suitable. The ordinary shares is suitable for parties that wish to exert some control. So when you are giving out your shares to the investors, and if the investors are going to ask you, so what type of shares are you giving us? So it's not just your decision, it will also be the investor's decision, whether the investor wants to come in so that he can have control, whether he wants to come in so that he can have the voting rights, whether he's coming in so that he's coming in on a loan basis, like, I just collect a dividend and I just collect this X amount every year, and also collect back my capital at the end of the maturity period, So it all depends on both negotiations between you and the investor, okay? So that is why it depends. It depends on what is the role of the investor when they come in, okay? So it's the common shares, or rather the ordinary shares, you see, they have certain control, okay? So it's suitable for the parties that wish to exert some control. If the investors want to have some control, then they will request for a ordinary share, okay? And if they don't, they don't want to have control, but they just want to collect their dividend just to be safe, just a fixed amount, irrelevant whether the company is doing extremely well or not, then they can come in with the preference shares. See, these preference shares are useful investment tools for parties with the following objectives. So it depends on your objective and requirements. See, number one, investors who do not require voting rights, and investors opting for medium risk. See, even there is risk involved, right? High risk, medium risk, low risk. So if they come in with a preference shares, their risk is, medium or lower risk as compared to the ordinary shares. Okay. Preference shareholders have priority receiving payment and dividends, but however, their returns are much lesser than compared to the ordinary shares. And investors who prefer a hybrid debt. So if they're looking at a debt, if they want to give loan, but it's a kind of a hybrid debt. Why they call it a hybrid debt is because it is a debt in form of investment. All right. So these are things that I would like you to read, the difference between the preference shares. So all this information is very important for you, so that when you read this information, okay, later on, you will know what type of shares that you want to give out to your investors. Or if they're asking for what type of shares, at least you will know what are all the terms and conditions of the shares, okay? See, redemption. Ordinary shares cannot be redeemed by the company. Ordinary shares also cannot be repurchased by the company. See, if you're giving out an ordinary share, you cannot purchase those shares back. Ordinary shares cannot be redeemed by the company. So you are the company. If you're giving out ordinary shares, you cannot redeem it back. But the preference shares, yes, you can redeem it under the redeemable preference shares, is what I mentioned earlier. Okay. And also you need to know what are the clauses involved in it. And also remember, ordinary shares you cannot convert. It's not a convertible type of shares. Only preference shares has the flexibility of converting. All right. So this is something that I have shared with you, and please read it later on when you have the time, so that when you're preparing your second presentation, you will know and have a better idea on what to offer your investors. All right. Okay, next, you will also need to prepare a PE ratio. Okay, what is a PE ratio? A PE ratio is basically your price earning ratio. Okay, so your price earning ratio. What is a price earning ratio? Now, this is very important now, dear friends. So please pay attention, because a PE ratio is basically what investors will use to calculate whether your company is worth to invest or not. Okay, so it is a ratio of a company's share or stocks, okay, price to the company's earnings per share. So for every 1 ringgit, example, how much value is there if they invest in your company? What is the value of each ringgit that they invest in? So that's a PE ratio. So the ratio is used to value companies and to find out whether they are overvalued or undervalued. So this is what an investor will typically use to check and see whether your company is overvalued or undervalued. Okay. Of course, your company will be benchmarked against other companies in the same industry. Okay, in order for them to derive this ratio. So PE ratios are usually used by investors and analysts to determine the relative value of the company shares as a apple-to-apple comparison. Like I said, another company, same industry, they will compare. It can also be used to compare a company against its own historical records. Okay, so instead of comparing with other companies, they will also use this PE ratio to compare with your own historical records of your past performance. Okay. So what are the key takeaways? Number one, the price earning ratio relates to a company's share price to its earnings per share. So a high PE ratio could mean that the company's stocks are overvalued, or else that the investors are expecting high growth rates in the future. And companies that have no earnings or that are losing money do not have a PE ratio, since there's nothing to put a denominator or to benchmark against. All right. And there are two kinds of PE ratios, which is the forward and trading PE ratios. So just to let you know, this is the formula of calculating a PE ratio. Basically, it's your price of your stock, okay, divide by your EPS, which is known as earnings per share. Okay, so all earnings per stock. Okay, for example, if the stock of company ABC is trading at 100 ringgit per share, while company XYZ is trading at 50 ringgit a share, the assumption might be that ABC is more valuable, correct or not? Why? Because ABC is 100 ringgit, whereas XYZ is only 50 ringgit. But however, if the earnings per share both are 5 ringgit, okay, that means the EPS, EPS is earnings per share, for ABC is also 5 ringgit and XYZ is also 5 ringgit, then the PE of the former, which is ABC, would be 20, while the PE of the later XYZ would be 10. Okay. So in case you are confused at what I'm trying to say, let me just show you a video that will explain in more details. All right. Okay, so enjoy the video.
Some investors use financial statements to create ratios that can help compare the performance of similar companies. In this video, you'll learn how investors can use the PE ratio to help compare the valuation of 2 or more companies. Let's look at an example. Suppose there are 2 companies that both make and sell snow shovels. Company A is trading for $60 per share, while Company B is trading for $10 per share. A new investor might assume the $10 stock is the best value because it's the cheapest, but this isn't necessarily true. A low share price does not mean a stock is undervalued. A stock is considered undervalued when its price is low relative to the amount of money the company earns, rather than compared to the price per share of similar companies. To help compare these 2 companies and determine which may be the better value, we need a common measurement such as the price to earnings, or PE ratio. The PE ratio simply compares a stock's price to its company earnings or profit. Now, back to our example. Let's say Company A is located in Wisconsin, which gets a lot of snow. Therefore, Company A sells a lot of shovels and earns a profit of $100,000 a year. Company B is located in Texas. While Texas is a big state with a high population, it doesn't receive much snow. Therefore, Company B only earns a profit of $10,000 a year. We know each stock's share price and each company's earnings, but we don't know how many shares have claim on the earnings. To put it another way, we need to know how many shares the company has issued to calculate the value of each share relative to the company's overall earnings. This calculation is known as earnings per share, or EPS. Because Company A has 50,000 outstanding shares and $100,000 in earnings, each share has a claim on an EPS of $2. Now that we have Company A's EPS, we can calculate the PE ratio. At a price of $60 per share and an EPS of $2, Company A's PE ratio is 30. This means its stock is trading at 30 times its earnings per share. Let's calculate Company B's PE ratio. It has 10,000 outstanding shares and $10,000 in earnings, resulting in an EPS of $1. The stock is at $10 per share, which means Company B is trading at 10 times its earnings or has a PE ratio of 10. In this example, Company B may be a better value, not because it has a lower stock price, but because it has a lower PE ratio. In other words, the lower the PE, the less an investor is paying per dollar of a company's overall earnings. Although the PE ratio is the most common valuation measurement, it isn't the only indicator that should be used when evaluating a stock. For instance, some stocks may have low PE ratios because they have limited growth potential. If Company B only sells snow shovels in a state where there isn't much snow, then it isn't as likely to grow. However, if both companies are expected to grow at similar rates, then Company B could be the better value based on its PE ratio. Also keep in mind that a high PE ratio isn't always bad. For example, suppose Company A is doing well because it invented a new shovel that pushes itself. This new technology could increase demand for its shovels, and the company could grow very quickly and potentially increase earnings. This kind of growth could justify a high PE ratio. In this case, a high PE ratio could indicate greater expected growth opportunities. If you expect earnings to grow, the current price may be worth the investment. The PE ratio is a commonly used and versatile fundamental analysis tool because it can help investors identify value and growth stocks. Just remember to compare price and earnings, and to keep earnings potential and other factors in mind when evaluating stocks. Because the PE ratio only factors in earnings per share and price, investors should consider using other metrics like dividends or projected future earnings to help determine a stock investment's potential. Thanks for watching. TD Ameritrade is here to help you better understand the tools and strategies you need to pursue your financial goals. To stay up to date on new videos, please subscribe. And don't forget to hit the bell to get notified about new uploads. Be sure to follow us on all your favorite social media platforms and open a TD Ameritrade account by clicking the link in this window.
Okay, so I hope now you understand what is a PE ratio. And basically, a PE ratio is what the investors will use to calculate the value of your company, or whether to invest and what's the worth of investing in every ringgit into your company. All right. So as what the video has given a very clear explanation, okay, the PE ratio is also a benchmark that is being used, okay, in your industry. Okay, so the higher the PE ratio, all right, as mentioned in this slide, simply means that if the PE ratio is high, that means investors are willing to pay a high price for a value of a price that is lesser. Okay, example, if your company is valued, each share is valued at 1 ringgit, but your PE ratio is 10, that means they are willing to pay 10 times more than 1 ringgit. If your PE ratio is 30, that means they're willing to pay 30 times more than your actual value of your share. So why are some investors willing to pay up to even 30 times more? Why? These are all like example, Berhad companies that are doing very well, or example, those companies that are listed in the New York Stock Exchange, or probably the KLSE, okay, and they are doing very well. These are all listed companies that are doing very well. And example, like Top Gloves right now, Top Gloves is doing extremely well. So their PE ratio is very high. That is why when an investor does his background research, his analytics, and he finds that the PE ratio is very high for Top Gloves, it's because that there is a potential growth expectation out of the company. Okay, so investors are expecting that there is going to be more demand for gloves in the near future as this pandemic is still continuing. All right. So because of that, definitely the PE ratio will be very high for companies like Top Gloves and other pharmaceutical companies, especially companies that are producing the vaccines. So that is why investors are willing to pay a very high price for a share, and they are willing to pay probably 30 times or 40 times more than the actual price of the share because of the growth rate expectations. So this is how the investors are going to value your company as well. Your company is not listed at a stock exchange market, or it's not a listed company. So of course your PE ratio cannot be very high. So when they do a calculation, your PE ratio, if it's benchmarked against other companies, example now, let's take Choco Hut for example. Mr. Vicky, your company Choco Hut, dealing with chocolates. Okay, so if a company investor were to invest in your company, and they have other chocolate distributors as well, they will compare what is the price value of your competitor and what is the price value of your stock, your company. Okay, and when they compare, they will see whether it's worth investing in your company and what's the growth rate or growth expectation of your company. And this is how they see whether it's worthwhile investing. So this is the PE ratio calculation that investors will use. Just to let you know, this is what investors are going to benchmark against. All right. Okay. So any questions so far on PE ratio? Any questions? Guys, are you all there? Or am I just talking to a blank screen? Have you all left your screen?
Here, yes, Alvin, we're here listening to you about P ratio.
Okay, good. I do appreciate some interaction once in a while, because I sometimes feel like I'm just talking to the computer,
No. You're not talking to you. We here listening.
Thanks a lot.
Tengah ada pelan-pelan.
Okay,
I'm taking care of my family at the same time, so yeah.
Good,
and
good.
listening. Yeah.
I will be sharing the recordings also for those who want to go through again, to just have an understanding.
Okay.
Right?
Thank you.
Okay, cool. So next, I would like to talk about another very important part here, which is called ARPU, ARPU, average revenue per user, or average revenue per client. Okay, so what is the ARPU? Basically, ARPU measures the amount of money that a company can expect to make or generate from one customer. Okay, from an individual customer. Okay, a revenue generated per user or per unit. Okay, so it is calculated by dividing the total revenue of your business with the total number of users. So this is based on a subscription model of business. Okay, example, if you're running a subscription-based business, okay, and you have X amount of subscribers, and you want to know how much there's each, like a telco company example. Telco companies will calculate how much revenue each of their customer is generating. So what it'll do is, example, if Maxis is making last year 2019, Maxis made 100 million ringgit. Okay, example, 100 million ringgit. Okay, and the number of users for Maxis is 10 million. So 100 million divided by 10 million. So what's the number? 1 million ringgit per user. That means, example, this is just an example. That means each customer is generating a revenue of 1 million ringgit. Am I right or not? Did I get my maths right? Or is it 100,000? Let's do the maths and see. Maxis is making, example, 100 million. And they have 10 million users. Sorry. So the revenue that is generated by each of them is 10 ringgit. Okay, 10 ringgit is the revenue that is generated by each customer. So why do you need to know this? Because only then you will know how much budget to spend for your marketing and campaigns and advertising, which falls under the customer acquisition cost. Okay, so example now, EJ, all right, EJ, you're running your scuba diving center, right?
Yeah.
Right. So example, EJ, if you're making for this whole year, now the year has come to an end, okay? For this whole year, example, if you made 1 million ringgit, okay? How much you made? Example, example, you have made 1 million ringgit throughout this whole year. And you had, sorry?
Sorry, you were breaking up a bit. So what was the question? I was making 1 million, and then what was
example,
after that?
if you made 1 million ringgit for this year, okay,
Right.
and you had 1,000 participants, example, you had 1,000 divers who came to dive with you, example, okay, 1,000 people dived with you throughout this whole year who came to your academy, your diving academy. So you take 1 million ringgit, which is your total revenue for this year, and you divide by the total number of people who came and did their scuba diving certification, which is 1,000 people. So 1 million divided with 1,000, you have 1,000 ringgit. So that means your average revenue per user, per client is 1,000 ringgit. Okay. So example, that means you're giving out your membership package, or rather your diving package is 1,000 ringgit, and you had 1,000 buyers. So your revenue has been, for this year, has been 1 million ringgit, right?
Right.
You get what I mean?
Yes, I get what you mean.
So that means, so if your revenue per user, or rather per customer, is 1,000 ringgit, then you know how much budget for you to fix to advertise so that you can acquire these people. You understand or not?
Right.
If you're making 1,000 ringgit, I'm sure you're not going to spend 2,000 ringgit to advertise to acquire one client. Am I right or not? So this is why ARPU is important. You need to know what is your customer acquisition cost. Later on, you will know how much actual profit you're making. Because your customer acquisition cost minus the revenue per user is your clean profit.
Correct.
So why do investors want to know about your ARPU? Is because, of course, number one, they want to know your profit generation capabilities. Okay. They can use this to determine the trends and the ability of the business to generate revenue from one user. Okay.
Right.
If they increase the ARPU, it indicates growth in your revenue. Number two, they also want to make a comparison with your competitors. They want to know how much ARPU is your competitors making in the same industry. Like if there's another scuba diving center in Langkawi, they want to know what is their ARPU so that they can benchmark it against yours to see how profitable is yours compared to them.
Right.
The same industry that will use ARPU calculation to examine how well are they doing compared to their competitors.
Makes sense.
Then next is financial forecasting. Remember, yes, earlier we were talking about forecasting, financial forecasting. So ARPU is also used, the tool that is used to do your financial forecasting. So now you know that, okay, per user, per client, you're making 1,000 ringgit. So next year, you want to increase your clients from 1,000 to maybe 2,000, so that you know your revenue automatically will increase from 1 million ringgit to 2 million ringgit. So financial forecasting is also, they will use ARPU, while it shouldn't be relied solely, but ARPU can be very useful for financial modeling and forecasting.
Okay. I usually think ARPU.
ARPU, yes. Okay, understanding customers. Okay, if you want to understand your customer, okay, and your customer segment, okay, based for example of location. Example, if you're doing a certain marketing campaign, okay, and a certain demographic area or a geographical targeted area you're doing, okay. So if you are spending this much for doing your marketing in let's say Langkawi, okay. So you know your ARPU tells you that, okay, from Langkawi, how many clients are actually coming? But what if you're spending your marketing outside Langkawi, maybe in Perlis, maybe in Kedah, maybe in Penang? So how many of them are coming from there? So you know geographically where you need to spend more if the customers are coming more from which location. So that's why I'll be able to tell you. Okay. And then lastly, investors evaluation. For investors to evaluate how healthy is your business before they decide to invest, they will see your ARPU. Then comes your customer acquisition cost. Okay, so ARPU is one of the two critical halves for calculating your overall ROS. What is your ROS? Your return on advertisement spent, okay, along with your cost per install or outbound cost. Okay, that means in other words, your ARPU, knowing the ARPU of your lowest and highest value users will enable you to optimize your marketing activities. So you know, if okay, one person is bringing you this much of profit, then you know, okay, how much budget? Okay, let's say if I'm going to spend 100,000 ringgit, okay, for my marketing, okay, and you have each customer is bringing you a revenue of 1,000 ringgit. So if you're spending 100,000 ringgit, then you need to measure and see 100,000 ringgit has brought you how many more clients. You understand or not? So example, this year you have 1 million ringgit revenue because you had 1,000 clients, customers. So how much money did you spend to acquire these 1,000 customers? Maybe you spent only 10,000 ringgit on marketing. Example, you spent 10,000 ringgit on marketing. So you take 10,000, maybe you did your campaigns, your advertising, and your whatever marketing campaigns and efforts that you did, you spent a budget of 10,000 ringgit. So with this 10,000 ringgit, you managed to acquire 1,000 clients. So that means your marketing expenses, your cost to acquire each customer was 10 ringgit, which is okay. Right? Each client you made 1,000 ringgit, but you spent 10 ringgit, which is good. But now you know that, okay, if 10 ringgit can bring me this much, then I need to increase my marketing budget, maybe 20 times, maybe at times 2, or maybe I need to increase my marketing expenses by times 3. So now I don't mind spending 30 ringgit, okay, 30 ringgit per person in order for me to get 3 times more the amount of clients. So now you can increase your marketing expenses from 10,000 to 30,000. And definitely if you do increase to 30,000, you know you will definitely see more clients coming in. Am I right or not? So this is why ARPU is very important for you to benchmark your customer acquisition costs. All right? Am I clear? Okay, maybe if I give you a case study, it will be more clear for you. All right? So let's do a case study. A case study on a few of the ARPUs that we have in the market right now. So we have Twitter, Facebook, eBay, PayPal, Alibaba, and you notice that Alibaba, the revenue generated by each customer is $29. So that's pretty high. So the ARPU is pretty high, right? You think it's high? Is it high for Alibaba? Hello, do you think the ARPU is high for Alibaba?
Yes.
Wait until you see this. Look at the ARPU for Amazon. Amazon is $752. One user is generating $752 for them. That's way much higher than $29. Am I right or not? So now you know why Jeff Bezos is the richest man in the world?
Yeah.
Because his ARPU says that average revenue per user for him, that means each client is paying $752. And can you imagine how many users he has or not? So if you do the maths, you'll know why he's the richest man. And then of course, Google. Almost everybody is using Google. Right? And look at Google's revenue per user, 256. That means if you're using Google right now, and I'm using Google, we are generating $256 for Google company. This is also how they evaluate the share price, the stocks. You know, if an investor wants to invest in Google or Amazon, they will see what is the ARPU. They want to know each user. How many users do they have? And each user, how much are they getting revenue? Facebook Canada alone, US Canada alone is about $112. Facebook Global is about $25. Am I right? Was it $25? Yeah. And then Apple. Apple. How many of you are using Apple phones here? Anyone? Say I.
Aye.
I am.
Yeah.
Quite a lot of Apple users here. So just remember that you guys are generating $194 for Apple company. Right. And how many of you use Netflix domestically at home? Anyone? Subscribing?
Again.
We do.
Yes.
Netflix, Spotify.
Very good. So if Netflix and Spotify, you guys have
Only
been
Netflix.
that means you have contributed $131 to Netflix. How much are you paying for Netflix? Monthly, how much are you paying?
No.
10 ringgit.
Okay, 10 ringgit. So cheap. Yeah.
Ada yang untuk account for 5 people tu.
I thought
Tapi
it's
that
about,
one account is 50 something lah.
so it's about 50 something, right? Okay, so per month, okay, so 50 ringgit times with 12 months, that's 600 ringgit divided by 4 because it's USD. So it's about $150. So yeah, about $131. Like I'm paying about less than 50 ringgit. I think I'm paying about 30 ringgit if I'm not mistaken. 30 or 40 ringgit. Can't remember. If I'm not mistaken, I'm paying about 30 something. So 30 times 12, 360 ringgit, divide by 4, which is $90. So yeah, see, I'm paying about $90 per year, and Netflix is making a revenue of $131 from me. Although I'm only paying $90, but my value to Netflix is $131. So you see, this is how they calculate ARPU, and these are some of the biggest brands in the world. Okay, any questions so far on ARPU?
Hey Alban, can I add something?
Okay.
Yeah, from the company listing here, we can sort of like we can all see yang semua internet based, meaning that bukan internet based lah, macam subscriber based.
Subscription based.
Subscription based is not macam one time pay and then they got subscription based macam untuk for sort of like macam a long period of time tu subscription based is the best lah.
Yes. Very true, Faris. This is a subscription-based KPI. Okay, ARPU is mainly for tech and also subscription-based models like telcos and all that. Okay. Now, one of the things that if you notice in the subscription-based model is their revenues are pretty stable. Okay, like if the ARPU is for Amazon is 752, next year you will see approximately around that much. You may see slightly more if there's increased users or maybe lesser. Like if you see the graph for Facebook, the ARPU has always been going up and up and up. Why? Facebook has always been increasing its users every year. Okay, and so as the users increase, the data increases. And what happens? Advertising rates increase. More business owners start to subscribe for Facebook services. Therefore, it starts to increase. So technically, Facebook is not a subscription because if you're using Facebook, you're not paying monthly. But who is paying monthly? The business owners. They're using Facebook ads on a monthly basis, on a yearly basis. So yeah, but of course they are not subscribers. You know, they go on campaign per se, right? Even Apple for that for that matter, Apple is not a subscription-based business because why? They sell their phones, they sell their gadgets, whatever, and then when the new model comes or launches, then they will upgrade. So even though it's not a subscription-based model, but still they have a very steady growth because why? They regularly come out with their new models and people constantly upgrade. Am I right? So even
But
if
they start to have subscription based now, macam Apple TV. They already started it.
yes,
Yeah.
iTunes, Apple TV, yes.
Yes, iTunes, Apple TV.
So that all comes under Apple services. Can you see there's two, right? Apple All and Apple services. So Apple services is yes, like what you are saying, the Apple TV and all that. So these are services that they have subscribed to. Apple All is their products. All right. Cool. Any questions? So if your business model has a subscription model, okay, this is something very important info for you. If your business has a subscription-based model and you can show investors that, yes, I have this many subscribers, I have this many users, I have this many data, that is a jackpot, gold mine for investors. You investors will really love to invest in companies that have subscription-based model business. Why? Because it simply shows that subscribers are increasing drastically, right? Let's say this year, look at Facebook, for instance. The subscribers started to increase. First from 1 million users to 5 million, 10 million, 100 million. Then next thing you know is they touch 1 billion. And now they've gone to 2 billion, correct or not? Or have they crossed 2 billion? I think they've crossed 2 billion, you know. So their graph has always been on the increase. Their users have always been increasing, month after month, year after year. So that is why if it's a subscription-based model that your business is, example, potong gula, Anas, you're there? Anas, are you there?
Yes, I'm here.
So example, why I mentioned to you the other day, create a subscription model for your business is because when you tell investors, hey, now we have introduced something and it's a subscription model business, whereby our customers are loyal customers and they subscribe to our products on a monthly basis. In fact, I already got a subscriber for you. I gave you the number.
That's correct.
So when you have a subscription model and people are actually subscribing to you on a monthly basis, like Gillette, for example, Gillette shaving foam, Gillette blade, people who you start using Gillette, they literally subscribe to that brand. They become loyal to that brand. So what one shaving company did was they started to, in fact, create a subscription model. They were approaching people on the streets. And when they approached me, they said, sir, we'd like to introduce this new product to you. You can try using it. And if you like it, you can subscribe to our blades, our refills, and our foams on a monthly basis, which is, and then they showed a comparison of prices. That even if you're a subscriber, you receive your products at your doorstep and you're still paying the same amount as Gillette, our competitor. So I was like, wow, that's interesting, right? So I'm not only, I have to go out to the shop anymore to buy Gillette or the foam and all that. I receive it every month and I pay the same price as I'm paying Gillette. And I don't, it's a convenience of my home. So you see, business are starting to move into a subscription model. And that is why I encourage, those who are in the, or even F&B business, a lot of F&B business here, Rafur, Anas, Kalai as well, F&B, GV F&B. Kalai, are you there?
Yeah, I'm here.
Even Kalai, it will be good if you can create your subscription-based model, which you can. You can go to corporate towels and all that. Nowadays, the younger generation of corporate people are very health conscious. And if you tell them, hey, we can give you a subscription for our sandwiches on a weekly basis. Maybe every week you would like to have a healthy salad and sandwich delivered to your office. Please subscribe to my services. and we will deliver them to the office before your office hours or during your lunch hours. So when you create a subscription model, now you have every month, you don't have to put in so much effort to acquire new customers, because your customers are increasing and your revenue is also increasing. A lot of times businesses are doing a big mistake by spending money every month to acquire new customers, and whatever new customers they have, the old customers just let go like that. Don't do that. Try to create a loyalty program for your customers so that they stay loyal to you and they subscribe to you. Like Potong Gula, the moment my brother, Rosli Royhan is my brother, by the way, the ones that you send the documents to. So when Inche Rosli was speaking to my cousin, and he spoke very highly about Anas and about Anas product, Potong Gula. My cousin was a diabetes patient, and he said, "Oh wow, this I never knew such a creamer condensed milk exists in the market. How can I subscribe for it?" He himself said, and then my brother called me, and then I just gave the contact details to him. So you see, this is a very good way of doing business. You know, if you're dealing with products, you may want to create loyalty, retention. This is called retention strategy. What's your retention strategy? You know, investors want to know what is your retention strategy, so that your ARPU is, you know, every month consistent and increasing on an increasing. So once you have a subscriber, you know, whether you're selling sandwich or you're selling whatever, you have subscribers. Every month, your income is fixed, but it's growing, because when you increase your sales, your income starts to grow. But at the same time, all those who have already bought from you are continuing a journey together with you. So these are the things that are appealing for a investor. I hope you understand what I'm trying to say, right? All good? Is it good? Hello? Are you guys there?
All good, all good.
All right, good. So I'm going to give you guys about 5 minutes of smoke break or toilet break, and I'll see you back in exactly 5 minutes time. Cool. Now it's 12:52. I'll see you at take about 7 minutes. 12:53. 7 minutes. I'll see you at sharp 1 o'clock, and 20 minutes after that we will be done. All right. Yeah, hi, welcome back, everyone. I'm going to share my screen once again. Okay, all good on so far. Any questions anyone has?
All good, all good.
All right, good, cool. So as what I just spoke about, the retention strategy, investors want to know what is your retention strategy? How do you retain your customers? Okay, they want to know, do you have a subscription model business? Or do you have a customer loyalty program? Example, if you see, how does Shell, okay, sorry, let's talk about Petronas. How does Petronas create brand loyalty for their customers? Can anyone answer me?
My Mesra card.
Yes, My Mesra card. So this My Mesra card, they collect points, and when they collect points, they can redeem them for either petrol or anything from the Mesra shop, right? So this is a customer loyalty program that they created, and a lot of petrol stations also have that, BHP, Esso, and all that, right? Shell uses
Bonus link.
bonus link card. So bonus link itself is a loyalty program card, right, for several brands. Okay, so that's something that you may want to consider for your business, and if you have, please present that to the investors to help them have confidence in your products and your business. And lastly, what is your repetitive sales or business plan? Okay, so how do you get clients to repeatedly come back to you? Like, do you have a sequel to your products? Example, if it's a service-based product, like for instance, my company is dealing with training and development, Business Warrior. So what happens after we complete an accelerator program like this? Is there a sequel to it? Do I propose to my client a sequel to this? That's a repeat business plan. You know, what is the sequel? A coaching. So these are things that you want to add on so that people will have the confidence that your business is on a uh, you know on a subscription model or on a repeat model. One of my client that I was consulting, okay, I have a client who I also do business consulting and business coaching. So one of my client my student who I was doing a business coaching, she started selling, she was selling tea bags, okay, custom made tea bags. That means she made her own tea bags, right? And she sells them online, okay? So there are various types of flavors that she produces, these tea bags. And basically she was selling them and applying the usual digital marketing strategies to sell them online. And when she wanted her sales and business to increase, she engaged me as her business coach. So when I came in, I created a subscription model for her tea bags, because tea is something that everyone drinks regularly. Sometimes people drink tea on a daily basis. Every mornings they drink tea. For those who are not those kind of tea lovers, you would buy and stock up on a monthly basis. So I said, why don't you introduce a subscription model for your customers, and introduce a loyalty package? And we created a subscription model so that the tea will be delivered automatically every month, and it's auto debited from their credit card. And that model helped her to really increase the revenue of her company. All right. So you see, just one thing only, subscription model. Now, not only does she have regular customers, she has loyal customers who are subscribing on a weekly, monthly basis from her. All right. And those who are subscribing on a monthly basis, or they have taken an annual package, that means they subscribe for 1 year plan, and they get a very good discount for the whole year. So even though she has to bring down her margins to give the discount, but at the end of the day, she has what? Database of clients. So imagine if she were to approach an investor, investors will see, wow, you have a database of 800 clients who are buying from you tea bags every day. then she can easily convince them, if you come in and inject your finances and resources, we can grow from 800 clients, 800 customers to maybe 8,000 customers or 80,000 customers. So, I created this business model for her so that, she is able to not just self-sustain, but attract a lot of investors. And now she has attracted one investor who has now helped her to, so she's in the early stage business of startup, and she's now doing it at a very large, bigger scale globally now. She is even sending it out to neighboring countries and all her tea bags. So, one simple thing can just create a ripple effect of success. So this is something that I would like to encourage all of you all to do. All right, good. All cool? All right, now last section for today is your company value versus the share value. So when you are offering, okay, first of all, let us know how to determine the share value. Okay, to determine the share value to offer to your investors, first you must determine the value of your business. So how do you determine the value of your business or the value of your company? So there are a few ways of doing it. Okay, number one is to actually there's 6 ways. I need to add one more.
Yeah. Daddy, let's go together. Yeah. Ini berat.
As you can see, there are a few ways of determining your business value or your company value. Okay, number one is the assets that your company has or owns. Okay, buildings, machineries, whatever that you own under your company, those are your assets. So your company value is based on, number one, of course, your assets that is registered under your business, company car, whatever. Number two, the average yearly net revenue. Okay, so once investors have determined your profit margin based on the audits, they will be able to know what is your net revenue every year on average. Okay, and then also you can base your company value on current and future projects. Okay, the value of the projects that you have, upcoming projects, the pipeline, and your current projects that you already have. You have secured a $5 million or $10 million deal right now. Okay, or for the next 2 years. So those values of the project, like Al Arifi was mentioning about the value of a project that they have been offered by their developer to take on the clubhouse. So that value of the project was 15 million, and part of the value of the project is they get to own the building, the whole entire clubhouse, the property, right, and the land. So for 15 million, that is the value that they own. That is the value of their company. And then comes your PE ratio, as what I was mentioning, your ARPU. So all these are ways to determine your company value. Now, apart from all of these that I mentioned, it is best that when the investor is serious, because you won't be able to assess your exact value of your company. Even if you apply all of this, you won't be able to assess the exact value. But however, if you want to assess the exact value of your company, then you will have to hire a professional valuer. Okay. Now the cost to hire a professional valuer is not cheap. For a Berhad company, it may cost a million ringgit. Okay, to assessment, evaluation of your company. For Sendirian Berhad and all that, probably in tens of thousands of ringgit. So what will happen is when the investor is really keen or has already 99 decided to invest in your company, then they will require you to hire a valuer, a professional valuer to come and value and assess your company. And they will give the exact or almost exact amount the company is worth. All right, all good? So please determine the value of your company first before you can actually offer. So determine the company's value before you can offer your shares. So once you are able to validate and determine and justify the value of your business based on your data, facts, proof, whatever, then the investors will, you can decide on how much shares to give your investors. All right. Okay, so the shares that is given must be equivalent and proportionate to your company value. So if you have successfully valued your company at, example, 1 million ringgit, say my company's value is 1 million ringgit, and you must justify with facts and data. Company is valued at 1 million because of this is what we have, this is what we own, this is the projects. Based on our past 3 years, 5 years, average revenue is this much. Okay, so in the next 3 to 5 years or so, this is how much it's expected. It may increase because of our pipeline. These are the upcoming projects that we have. These are our expected increase in sales for this much. Every year, if you notice, our company sales are increasing by 5%. So all these things, when you accumulate this data and you tell them, so this is why we valued our company at this much. So once you have justified with them, then you tell them, okay, I'm giving you 20% of my company because my company is now valued at 1 million ringgit. So I need to raise funds for 200,000. Therefore, I'm giving you my shares of 20% of the company. So then the investors will say, okay, the value of the company is 1 million. I'm buying 20% of the value of the company. So I have to pay 200,000. And what do they get in return of the 200,000? That's the most important thing they want to know. You're giving me 20%, fine. So I can expect every year to have a gross income of from your value of your company. So every year I can expect how much? How long is the period of my all these things the investor needs to know. So you must be very, very clear of the value of your company and the value of your share. How much shares are you giving? What is the value of your company? Please do not go and ask them. The investors, I'm giving you 1 million ring. I'm asking for 1 million or 2 million or 3 million or 5 million ringgit, and I'm giving you 5% or 10% shares. If you ask for 5 million ringgit and you're giving 10% shares, what does that mean? That means your company is valued at 50 million ringgit. So if it's a 50 million ringgit company, then you better be able to justify to the investors, hey, my company is 50 million and I want to raise 5 million, therefore I'm giving you 10% shares. So you get what I mean or not? So before you ask the amount, make sure you know what is the value of your company and how much percentage to give in return of the investment. All right, okay. I hope there is no questions, so we can move to the next one. So the last topic for today is the exit plan. What is your exit plan? Okay, what is your exit strategy? Okay, or what is your exit agreement? So it is important for both the investors and you, the business owner, to state the exit agreement at the pitching session or initial stage itself. Okay, why? Because you need to have a common platform, a common mutual platform. Okay, because when an investor comes in, they want to know how long are they going to be there, how much money has to be put in, and when they can collect back their payments, and how much profits can they make, what is in it for them, they need to know. So you have to indicate your buyback terms. Example, if you are giving out your equity for 20% or 30% to these investors for a period of 5 years, you want to lock them for 5 years. But in the second year itself, you have the cash capacity to buy them back and you want to take back your 30% equity. So what is your buyback terms? Because if you don't put this, lay out these buyback terms, then later when your company starts to do very well, there will be a dispute between you and the investor. So in order for that dispute not to arise, you have to indicate what is the buyback term. If I want to buy back the shares after 3 years, what is the terms and condition? What is the value at that time? Do we value the company based on what? How much will it be for me to buy back those shares? all these terms and condition has to be put into your exit agreement or your buyback terms and condition, all right? And most importantly, you need to indicate also what is the period of investment terms. How long is the term? If the investors are coming in, how long? They're not going to come in forever. They're not going to stay in your company forever. So they need to know, what's the time frame. Okay. So whatever additional information that you can provide, please provide the investors and give them some options for them to choose. All right. So, any questions so far? We have come to the end of the session. So is there any questions? Hey guys, any questions? Hello everyone.
Hello. Later on, while we preparing if let's say we got selected and then we prepare for the investor, can we ask the question then?
Oh yeah. During the next session, you also can ask as many questions. The investors will have a lot of questions. So it will be a very long session. That is why each participant will be given about up to maximum of 2 hours. Understand? Got it? Hello? Am I mute? No, I'm not mute, right? Hello?
When can we know who is selected and who is not?
In about 1 minute's time.
Okay.
But before that, I need to know whether you guys are clear with all these or not from the start of our session. So, are you clear with all this? What do you
I'm
need?
good so far. I'm good.
All good, huh? Okay, very good. So if everyone is clear, then you need to prepare whatever that is inside here that I've told you. You have to prepare a revenue forecast, financial projection. You will need to know what type of shares are available, what type of shares are you going to offer the investors. Please do your own additional research when you're preparing the next pitch deck, okay? Don't just depend on me, on my resources. Use your own wisdom and knowledge and research data, okay? So what kind of shares are you going to offer them? What are the advantages and disadvantages of each of these shares? What are the what is a PE ratio, okay? And most importantly, what is your average revenue per user? What is your customer acquisition cost? What is your retention strategy? Do you have a subscription-based model? And then what is your company value and what is the value versus the shares that you're offering them, company value versus the share value. And then last but not least, make sure you have your investment, your exit strategy, or rather your buyback agreement ready. Talk to your lawyers and then tell them this is our buyback agreement. So during your pitch, you must mention to them, if we were to buy back our shares, what will the terms be? And see if they agree to it, because they will also have a lot of questions. You need to really know. So speak to your lawyer to, find out what is the best buyback agreement or exit agreement that you can prepare. So once you got all this data, put it into your slides, into your presentation deck, and then we will have a very fruitful session during the second round. Okay. So overall, the participants who have pitched to the investors, you all did a very outstanding job, okay? And so do you guys want to know what's the outcome? Come on, I can't hear anyone, if I don't get any response, I'm not gonna. You guys want to know or not? What's the response?
Yes, ready.
Yes.
Okay. So the outcome is there has been 9 participants that have been shortlisted to go to the next round. So congratulations to all the 9 of you. Ruben, Kamal, Rafor, Faris, Hadri, and Eza, Anas, Brian, EJ, Nicholas. So the 9 of you get to proceed to the next round. And for the others who have already made your pitch and was not shortlisted by the investor, do not worry. What I will do is we will get in touch with you individually, personally, and see how else we can try to assist you with whatever that is available right now. Like some of you are potentially capable of getting some grants. So let's see how we can try to arrange any grants for you or any kind of assistance. So Business Warrior is still going to support you, not just in terms of grants or finance, but whatever ways that we can contribute our resources to help your business. Okay, so for the rest of you who have not been selected, we will still be in touch and we will still assist you through your business by contributing our resources and expertise. Okay, is that okay? Everyone can unmute and
yeah, thank you very much for the opportunity.
Okay, most welcome and congratulations to the 9 of you who have who is going to proceed to the next round. So please prepare accordingly to whatever that I have spoken today. Additionally, if you have other things that you would like to add, please feel free to add into your pitch deck. Okay, and you got to be prepared financially, lah. You know, your financial paperwork has to be really prepared. So you have to submit your audited report as what is mentioned here. Your audited report for your company, or your finance, your management accounts, okay, and your forecast. That is also very, very important. Your revenue forecast, because based on all this only, the investors will decide whether or not to invest in you. Is that okay? All clear, loud and clear. So for Mr. Vicky from Choco Hut, your name is not here because yours is a very straightforward case, whereby the investors are already have decided to help you explore China market. Okay, so Ian has already told me that you are already they're waiting for the borders to open before he can bring you into China market. And I will personally help you to assist you to get into Vietnam market together with Anas from Potong Gula. All right. So, Mr. Vicky, this is just an information for you. So yeah, the next round, if you want to make your pitch, is also okay, but it's just that the next round is for those who are looking for fundings. So that is why their names are there. You are also technically selected, Mr. Vicky, but it's just that you will be. They're just waiting for the borders to open, and they have already decided to help you to explore the China market. They have their China counterpart to bring in your products. All right. All right. So congratulations to all of you all who have been selected to proceed to the next round, and those who have not, don't worry. Congratulations to you as well. You guys did an outstanding job. We will still assist you, and let's see how we can make 2021 a great year, a year of growth, and also a year to rebound from whatever mess that we were in this year. All right. So thank you all so much, and please prepare your pitch deck and send your pitch deck to me at least one day before. If possible, by 15th of January. Okay, before the 15th of January, please submit your pitch deck to me so that we can run through and see how it is, and let me help you to really prepare before you meet the investors the second time. Okay.
Before 15, right?
Yeah, before the 15th of January.
Right.
Yeah, you got approximately 2 weeks plus, slightly more than 2 weeks, 2.5 weeks to prepare. So
can we have a template or sample for this round 2?
No templates, no samples. Whatever that has been covered in today's training, all those information must be inside there. So use your own creativity and prepare. The important thing is, forget about templates. What is required is already inside this training. So like what I mentioned, your audited report, your forecast, revenue forecast, what type of shares that you're giving them, what is your company value and how much is the worth of each shares that you're giving. Okay. So these are and your ARPU, your ARPU, average revenue per user, and the PE ratio. So these are the things that they want to see. All right, cool. Any other questions?
None at the moment. I'm good.
Okay, if there is anything that comes up from time to time, please post in a group and we will be happy to assist you. And let's hope for a very fruitful outcome on the next round. Okay.
Okay, Alban.
Awesome. So thank you all so much, and let's reconnect again on the WhatsApp group. From time to time, I'll keep you all posted on when is the next round session. And also for those who have not been selected, I will be in touch with you personally to see how we can move forward. All right. I'll be sharing the slides for today's session as well. And today's session has also been recorded, so I can share you the YouTube link later for you to have a refresher to see. Okay. So if there's no questions, thank you all so much. Thank you for your time and thank you for your participation. And I'll see you all soon. All right.
Thank you, Alban.
Have a pleasant Sunday. Bye, guys. See you.
Bye.